Miles Faulkner, welcome to Built to Sell Radio.
Thank you. Nice to be here.
So tell me about Blended Perspectives. I'd like you to explain this company and what you did as if I were a 12-year-old.
Okay. Yeah, sure. We were what we call a dedicated reseller and consultancy. The Atlassian products that we sold were software, as well as the Atlassian private cloud solution. And we did.
Got it. So Atlassian, I've heard of Atlassian. I forgive me, I don't know much about it. They have things like Jira.
That's right.
And there's another product called like Contagion or something.
Confluence.
Confluence. That's right. And these are like for big companies who have like super complicated processes. They use these products to manage projects and processes so that they get done quickly and on time. Am I getting that roughly right? Or
yes, it's that's some of it. They are very big on teams. Their actual stock symbol is team, and so the goal of Atlassian is to provide software solutions for every team. And where they sort of really started off was sort of what we call bug tracking, and the software was built. Jira was built in such a way that it's very easy to configure it and be able to support any process really. We sold a number of solutions which didn't involve support or tracking of bugs and that kind of thing. But where it really sort of took off was in the agile development world. And for the listeners who aren't too familiar with agile is a different way to go about implementing software or really anything. And that agile is about a more scientific view of what a team can produce. So instead of a stage gate type methodology where there's different phases like requirements and then the build stage and the implementation stage, you would actually do a small piece of work over, say, 10 days. You would see how the team performed, what the velocity of that team is. And then you would say, well, okay, we've got 10 more of those that we're going to need to do. And so it's very much about a joint team-based understanding of what it takes to build software. And it's much more accurate. And really all large corporations today have adopted Agile in one form or another. And to give you a sense of the scale of Atlassian and its success, 70% of all Agile teams in the world today run on Jira. And they have some 250,000 customers now. A company like ServiceNow, who you may have heard of, has only 7,500 customers. The sister product to Jira is Confluence, and Confluence is a wiki product. So instead of storing your files in a traditional folder system, you basically create documents in the wiki, and it complements the Jira software project management style. And they have also recently moved into the service desk space, and have very successfully, gone into that area, and they have some 35,000 customers. Blended Perspective.
And so Atlassian is the company's product, which your business, Blended Perspectives, was reselling effectively. And a lot of our listeners, although aren't into technology in any way, but they will get the idea of distributing someone else's product. They could be a manufacturer, or they could be a distributor. And they kind of get this idea of if you're a distributor, someone else does the making and they do the selling, and effectively the selling and the implementation. So you're, as I understand it, using these products, the Atlassian portfolio, Jira and Confluence, as sort of raw material in a solution for a client. Am I getting that correct?
That's right. And in fact, Atlassian, one of Atlassian's great strengths in its early days was that it consciously focused all of its efforts on R&D and had no salespeople and had no consultants. So they were very, very enthusiastic to bring on board partners. And I think, if only I'd known earlier in my career, how successful and frankly, relatively easy it was to be successful with them, I would have started earlier. But we got going, and Atlassian is very, very supportive of their solution partners. Yeah.
So tell me how you joined the business, because I understand there's a guy named Martin Cleaver, and we were talking offline about Martin, who was doing some work in this space.
Mm-hmm.
How did it come about that you joined up with Martin? Just tell me that story.
Yeah. So I was doing large programs. So my background is, I was a partner at Ernst & Young, and then I went out on my own when they sold the business, the consulting business. And I went on my own and ran large programs. I was doing a program for one of the major banks in Toronto, and I came across Jira as part of that exercise. And I realized the potential of the software to enable us to solve a range of different problems. And we were doing it very successfully. Yeah, it was quite remarkable. And it just so happened that this bank was also the sponsor of the Atlassian user group meeting in Toronto. And Martin was at one of the meetings, and I went to it. I was more of the Jira guy on the project management side, and Martin was the Confluence wiki guy. Had a big reputation and following in the wiki space. And he was really, to complement and to round out the offering, he really needed a Jira guy, to come on board, and also somebody who really understood agile and program management. So we sort of teamed up. We had a couple of false starts, in between large programs. I kept going at it. We kept working with Atlassian. The nice thing is that because Jira is everywhere, it was really a decision based on which partner to use. And at that stage, there were a couple of big partners in Canada, but they were pretty busy. And so we got into one of the big banks, and they selected us to be their partner. And the way that the software, the model works is that we buy the software from the vendor, the OEM, and we resell it to the customer. But what's very nice about this arrangement is that we can sell the software to the customer for less than the retail price. And the retail price with Atlassian is very obvious. They're not hiding at all what the cost of the software is. And what that meant was that customers could readily see, I can buy it for less from Miles, and he's giving me service to look after this product and figure out what it is that I need. So, I'm going to do business with Miles.
How much of a margin did you get? So if Atlassian's price on their website is like $100 for a widget, what would you buy it from Atlassian for?
I can't comment on that. It's just, but let's just say that it's sufficient and very sufficient. And depending on the nature of the offering. So for instance, to move all the server customers over to cloud, which is what they wanted to do, they were offering incredible margins for us.
Got it.
In many respects, the way we treated this was that the software business and the margins were our form of venture capital. We didn't ever have to go into debt to grow the business because we were successful. We had over 120 customers when I sold the business, pretty well all of corporate Canada. These were well-known customers such as Rogers Cable Systems, the largest cable provider.
That's not going to mean a lot to a lot of our listeners outside of Canada. So, but I suffice to say, big Fortune 500 type companies were using the product.
That's right.
So let's just go. I just want to go back to the cash flow for a second. So the margin you can't speak to, but suffice to say, it was healthy in particular to move from premise to cloud. There were extra incentives and so forth. I get that. How did the cash move? So let's say you mentioned you buy the product from Atlassian and then you resell it to the client. Just walk me through the cash. So when you say you buy it, would Atlassian give you terms? Do they give you 60 days so they effectively float the implementation, or do you have to pay upfront, implement, and then get paid by the actual client? Maybe just walk me through the cash model.
Yeah. So it's been a while, but you have to be first of all, you have to be a partner of stature. So for instance, I believe that only platinum partners or a certain level of partner get get the terms that I'm about to explain to you.
That's helpful.
Atlassian gives you 30 days. So they'll release the software keys to the customer. They'll then send us a bill. We will send the customer a bill. And then we got to get the money from the customer in 30 days, or we have to float the deal. By and large, our customers were good. But there was one customer, a government that claimed to have lost the
It's
check.
always the government guys that pay the worst. I don't know what it is. It's all, whenever I ask about AR like nightmares, it's always the government division that strings out the business for like months. So tell me the story. How long did the government take you to pay?
Yes. Well, in the end, it took somewhere close to 90 days, and it was over $1 million. Now, Atlassian is usually very strict about this 30 days. But, we'd been doing business with them for many years. And frankly, we explained to them, this was the situation, that it was a government that, that they will pay. And they were very kind to us.
That's great.
They didn't bill us. They just said, look, keep an eye on it. Just, which goes along with this idea of, we were fortunate that we'd found a software company that was such a nice outfit as Atlassian.
Yeah, sounds like it. So walk me through the legal structure of how you set things up with Martin, because you met at the conference, you're pitching for this work. In the early days, was it like your sole proprietary and his sole kind of partnered up to create a comprehensive solution, or did you actually legally incorporate a company together? Yes,
we did incorporate the company. It was sort of incorporated already, but we firmed things up with a shareholder agreement.
How did you split the equity?
Again, probably a bit confidential. Let's just say that Martin was initially Martin was the primary shareholder, but we had a plan which we documented as to how we become 50-50 shareholders. So I had opt-in rights over periods of time to pay Martin for the market value, and we had the company assessed by a proper assessment person, and so it was a smooth process. Martin took a mature attitude to this because he was well aware that I had much more business experience, having run a consultancy, having managed large, complex environments. And so I think, Martin had a mature a belief in this, and I ended up, paying him for the balance of the equity, and which really was a very fair and equitable arrangement.
When you say the balance of the equity, to top you up to 50%.
That's right.
Got it. And this is really helpful because, again, a lot of our listeners would have considered, and we talked offline about this a little bit, this idea of bringing in a more seasoned executive, bringing in a partner, bringing in someone who could really turbocharge their business. And so I want to dig in a little bit more on how the structure was, to the extent that you're able to share. But my understanding is you had the rights to purchase up to 50% of the shares at a predetermined, was it a predetermined price or a predetermined multiple of the revenue of the company or of the profit of the company?
We just said we'll get a professional valuation firm to at an appropriate time come up with a number. We agreed with the numbers, and that was it. That was that.
And when did you exercise that right? Was there a time limit on that right, or was it in perpetuity?
I don't recall there being a time limit on it. There was obviously, from my perspective, an urgency because I didn't want the company to be too valuable big by the time I bought in, and I think Martin understood that, from my perspective, it was only fair if I was doing, a fair amount of the work to grow the business, yeah.
Yeah. That's for sure. Some, people in your situation, and maybe maybe this is something you considered, would have said, well, do I really need Martin? I mean, I'm the one who's I was the partner at Ernst Young. I've done all this stuff. Who's this kid with the wiki thing? Like, why don't I just do it on my own? And like, did that ever cross your mind? And if so, like, take me through your thought process of not doing that.
Yeah. So, of course, I think over time, I played a larger role in the business. That's true. Martin did, step back. But I talked to a lot of people, and I know that, we were so busy growing the company, and it was so moving very quickly. Martin is a lovely fellow. I've always enjoyed working with him. He didn't, interfere very much with the business. It was very encouraging. I felt, again, I was lucky to have 50% of this thriving, fantastic business. I spoke to quite a few different people who told me horror stories of, buyouts and forced, exits and so forth. And I just felt that it was better to be just flying along and being successful. It was working. It was a great formula for us. Martin's really very much a part of the fabric of the company. So we just didn't make a change. We just kept sailing along.
How did his role evolve as you grew? In the early days, you were very much connected. I looked at his LinkedIn profile before our call. He lists himself as, I think, I want to say he might list himself as co-CEO between 2017 and 2020, and then not after 2020. I think he dropped that. Was that a formal thing? Like, how did his role sort of evolve?
Yes, so he
gone more and more.
He and I were co-CEOs up till then. I would have said, he'd stepped a fair bit back in that time. And then he played much more of a silent role in 21, 22, 23. And, we had grown into, a pretty complex, fast moving operation. Our finances, needed professional help. So we just, Martin sort of stepped back as his chief strategy officer. And, whenever we needed to make big decisions around things like corporate taxes, corporate structure and everything else, Martin was always fully involved.
Makes sense. Tell me about the decision to launch the Mars product, because a lot of people in a distributor business model, they tend to attract very low multiples because acquirers look at them and say, well, there's no point of differentiation. I could just go direct and pick up all those clients if I just lowered the price. And so they tend to be very poorly valued business. But I understand part of why you launched Mars was to make Blended Perspectives on its own right a valuable business. Maybe walk me through that thinking.
Yeah. We actually had two pieces of intellectual property. One was called Synthesis, which I can discuss also if you're interested as a follow-up. Yes. In the reseller business, there are a number of companies like ourselves. We pretty well all did the same thing, talked about how Jira was great, but actually the customer didn't need to be sold on Jira. They needed to be sold on why us. And so one of the things that's interesting about Jira is, and Confluence, they're actually platforms. So in many respects, the reason why you buy an iPhone is because of all those apps that are available, right, to download on your iPhone. You don't say to yourself, "Oh, I don't like the iPhone because of all these apps." You say, "I like the iPhone because of all the apps." And the same is true of Atlassian. So Jira has a marketplace, and again, Atlassian were very, very clever. They said, "Let's have other people build all the functionality to run on this app. We don't need to do that." So they saved a lot of money that way, but added functionality to the app. And there were somewhere in the region of 1,500 apps. Or was it 3,000? Might have been 3,000 apps and 1,200 vendors. So it was a very, very busy marketplace. And again, you could go to that and download those apps, or you could buy those apps through us. One of the things we learned from our customers was that they were a bit frustrated because they didn't know which app they needed for what thing, or they downloaded the first app they found that did what they wanted it to do. And there was no strategic kind of value to it, thinking. So we looked at this marketplace and we realized it was open. So there's an API that you can go in and just grab data. But because all the pages are public, you can extract that data. So basically what we did was we hired a programmer to go and gather all that data on a consistent basis. And we did it. We started back in 2020, or it might have been 2019. And we started collecting this information and putting it in our own database. And we were able to do some very interesting things that we weren't aware of before we started the process. So I think when you get into something like this, it's only then that you start to see the opportunities. What we realized was that, let's say there's a category of apps that's time sheets. Pretty straightforward. You would think that apps that you type in timesheets as a category and up comes all those timesheet apps. Well, it turns out that the way that Atlassian categorized all these apps is by allowing the vendors to self-categorize. So what they were doing was every app was in every category. So basically, 100 different apps that had nothing to do with timesheets would come up when you typed in timesheets. So we recategorized all the apps above 500 instances ourselves to create our own categories. So a customer could then literally come to us and say, help me with timesheets, which is give me the data on timesheets, who's a winner, who's a loser, all this sort of stuff. So we did that. Then what happened was we started just using it as a marketing vehicle, which was also very, very successful. So we trademarked Mars as an image, because Mars stands for Marketplace Analytics Research Service. That Mars has been trademarked by chocolate companies, you name it. But the image itself that we created, we could trademark. So we trademarked that. And then we just had the top 10 fast moving apps as a post, or who are the winners and losers in the app marketplace, or there's a consolidation taking place. AppFire's bought another app, and we did all of that, and we started mentioning all the vendors, who then all became our best friends because they loved it, and so it really took off. And 𝙬𝙊𝙇𝙇 is continuing on with it as a standalone, almost a standalone marketing vehicle, because it's just been phenomenally successful. And when somebody thought of blended perspectives, and why would we be a better partner than somebody else? We can say, well, because we've got Mars, like we have the history. We can really guide you forward.
And what was Synthesis?
So let's just step back and talk a little bit about Jira. So Jira is a sort of very configurable, workflow-driven tool. You can set stages up and information changes. When a ticket is open, it's closed. Those are the example, just a couple of the workflow stages. What we realized at some point, in the evolution of the company, was that we were doing sort of standard consulting jobs. So we would do a standard agile engagement, or we would do a service desk engagement, or we would do a governance, risk and compliance solution. The same issue types, like risk as an issue type, or a deliverable might be an issue type. For Rogers Cable Company and for others, we built a portfolio and project management solution. We templatized the whole thing. So we didn't just templatize it, we actually built it as a generic solution that we could start with a customer and say, okay, let's just imagine you're doing risk management and you want to track your risks. Instead of saying to you as a customer, do you tell me what you want to record in your risk record? We would say, okay, we've already built this risk record. This is what it looks like.
Check all that apply.
Fields. Which ones do you want to change? So we were able
Yeah,
to then use agile implementation to change something that was already manufactured, as opposed to sort of a clean sheet. And it really did accelerate our solutions. And again, a lot of intellectual property around that. So we drove.
How did you protect that IP? And how did you protect the IP in synthesis?
How do we protect it? I mean, it's. I guess it's one of those things that technically isn't all that protectable. I would say the volume of it was quite substantial, because what we were doing was every consulting engagement that we did, we would essentially use whatever the learnings were from those engagements and put them into our offering. And so I would say also that it's very difficult to catch a moving train. Because we had like 25 or 30 professional staff who were constantly working on engagements, constantly updating synthesis, we were always going to be one step ahead of everybody else.
Take me through your thinking around launching the IP, in particular the Mars product and synthesis. It sounds like in the beginning, it was a way to differentiate yourselves as a reseller of Jira than just, a generic reseller of Jira. This was a way to differentiate what you did and win business that you may not have gotten from someone who's just looking for a Jira implementation company. Am I getting that correct?
Yes. It's difficult to say sometimes why you win a big customer. We were only 40 people, and we weren't an international name like an Accenture or somebody else. So why would a company, why would one of the world's largest financial institutions based in the US, pick little old blended perspectives? Well, in my opinion, we would do a call with a customer and we would introduce our credentials, and they know that we're a platinum partner of Atlassian. So we're already coming with a lot of credibility, which is really a very important part of the whole reseller process. When you have that authenticity that a company like Atlassian gives you. But then they'll look around. Then they'll look at your presence online. They'll look at your website. They'll look at the depth. They'll look at, are they experts in things? And we were very, very prolific in terms of posting materials, leveraging Mars. We worked very hard on our branding, simplified our branding so that we could just pound home that Blended Perspectives was the biggest player. I'd say we punched above our weight there. I simplified the logo, for instance. We had a squiggle and Blended Perspectives, but the squiggle and Blended Perspectives would, on an electronic basis, meant Blended Perspectives name wasn't as large. And so we just got rid of the squiggle. And so we would just, relentlessly, get out there and shamelessly build the brand in any way we possibly could, in the belief, that when customers started thinking about who they wanted to do business with, that this would help us. And it certainly did.
At what point did you start to think about the value of Blended Perspectives? Because presumably in the very beginning, when you bought in, you had a valuation done. Do you recall what the formula that the external evaluator used? Was it a multiple of revenue or ARR or EBITDA?
Yeah.
Do you remember what their multiple was?
It was the industry standard multiple of net of adjusted EBITDA.
Do you recall what that multiple was, or what is the industry standard multiple in MSP and in managed services companies? What's the adjusted EBITDA multiple?
I just can't say. I mean, I've talked to other people about, what seems to be going on in the industry now, which is sort of 3, 4, 5, 6 times. The sale that we made was well in excess of that. The reason why this all started was because essentially there's a platform play going on in our space. We were approached a number of times by other companies wanting to consolidate in our space. And there's a feeding frenzy going on right now still. And it's a two-layered play. So a venture capital company or a private equity company comes in and buys one of us and then says, okay, if I buy, say, 3, I can get a much better multiple on the 3. So I think, we were watching closely the space in terms of our competition being acquired. And so we said, well, if everybody else is selling, let's sell ourselves. And so, I'm not a spring chicken. If I was 20 years younger, perhaps I would have stuck it out. But no one wants to be still standing when the music stops, right? So that was really the driver, and we were successful.
When you say still standing when the music stops, you sense there was this private equity fueled consolidation of Atlassian resellers.
Mm-hmm.
And if you didn't get on that train, you stood to be the one independent company fighting against this giant amalgam of private equity fueled competitors.
Well, that's true.
What you mean by?
I mean, it's a double. There are two factors. One, obviously, you don't want to miss out, and 2, you don't want to be up against much larger competition. All of a sudden, the two, at least one of the companies that we would see a lot in the Canadian space, had just received a huge whack of venture capital, and were much larger all of a sudden, and so. That's not a great thing either.
Miles, what proportion of your revenue at this time in, kind of call it 2021, 2022, that sort of era, and I'm just looking for ballpark numbers, would have been recurring?
Well, yeah. So we would have. I'll just take you through the different types of revenue we have, and talk about the model. And this is an interesting question because it points to one of the key things that I did, which I also believe it was important for our success, and that's the forecasting. So the way that the software business works for us is that customers typically renew once a year, or sometimes once every 2 years, and in fact. Because sometimes they renew every 2 years, you see a dip in our revenue. But revenue is a little misleading in terms of the success of the business, because our total sales, isn't what we're taking home. We're only taking a small percentage of those total sales. But nevertheless, that we were able to establish that obviously they would come back every year, and that we had a 95, 96% renewal rate. And so with 120 customers, it dawned on me that still those renewals would be worth quite a bit. And so we painstakingly built a forecast where we took every single one of those customers and we mapped out for 5 years, what this would mean. I built a kind of sophisticated model, hired a CFO who was very strong in this area, and she was wonderful. Whereas before I had a kind of not so great spreadsheet, which tended not to be updated as often as it ought to be. We made this a kind of critical part of our operation where, the sales team, despite some groaning, would have to update the forecast. We used Jira actually to do that. It was very successful. People don't realize what you can do with Jira. We basically, for instance, in a consulting business, what you really need to know is when is the money coming in? And we realized that actually the consulting work that we were doing, and even new sales to old customers, started to actually look like a formula. Because we already had 120 customers, we did an analysis, and it seemed to be that we would always get extra business from these customers because there was enough of them. The probability was somebody would wake up one day and say, I want to buy this, or I want to upgrade that, or I need some help doing an implementation. And so we were able to get to a fine art, kind of what the steady pace of the business looked like over the next, say, 3 years, just because we had a book And then we said, well, what happens when we win a new customer? And so we analyzed what's the value of a new customer. And we were able then to add that to our forecast. So we were then only needing to figure out what does our new customer growth rate look like? And so that new customer growth rate literally would roll right into our forecast. And in terms of the process of acquisition, the buyer was extremely impressed with our forecasting approach. We never had any questions as to the validity of whether the company would grow in the way that we were saying, because it was just really well elaborated.
What was your top line growth
forecast?
What was your top line growth rate projection? Like, what were you projecting to grow top line? Ballpark.
I think we were somewhere in the region of 20%.
Got it. And then in terms of the revenue, so you had these contracts with these 120 customers that renewed either annually or every other year. And they were renewing at a very high clip rate, 96%, something in that neighborhood. So that became sort of a base of contracted revenue effectively. And then you added to that new contracts over time to get growth. So that's a base of revenue. Did you also have one-time implementation revenue where it would be a one-off project where there'd be revenue that would be just one-off in nature?
Yes, they're all like that typically. We did have some support contracts that were sort of long-term, but what we were able to realize by studying the past, looking very closely at the past, what made this month, what kind of caused us to have this level of business performance? We realized that with 120 customers, even for consulting, the probability was high that a certain amount of consulting would happen.
I see.
So basically we would say, okay, X $100,000 worth of consulting just is going to happen. And
so it wasn't contracted revenue, it was forecasted, but because of the accuracy of the forecast and the data you had of the past, you felt, and the number of customers, 120 would obscure out any weird anomalies among one, you could fairly accurately predict the future.
That's right. The more we studied the past, the better the forecast looked in the future. That's correct.
That's helpful for sure. So let's get into this. So in the industry, your own transaction in the early days, and then you sort of had this sense of what was the industry. You go to conferences, they were kind of thinking 3 to 6 times adjusted EBITDA was where, an MSP or managed service provider would typically trade. Is that right?
Yeah.
Got it. And so you thought, if I'm reading this correctly, you thought because of Mars synthesis, the accuracy in forecasting, the size of your company, that you might be able to do better than that. You felt like you could maybe get.
Yes. I think, remember that it's context specific, sector specific. Atlassian is very hot, very fast growing. When you look at us and our growth, all you need to do is compare it to how's Atlassian doing. It's easy to value. We were strategic to these companies, and so I think you have to look at the context of which business you're in.
Yeah, for sure, and Atlassian is obviously a very exciting company, growing quickly. You mentioned offline, and again, we don't have to get into what the number was, but you mentioned that you had a number that you were hoping to achieve through this exit. Maybe walk us through your thinking there. How did you? I think people would be curious to know. I've heard everything from it was just a goal of mine to have that number. I can't put a finger on why I wanted that number, to we did, 5 valuations of the company. We have exhaustive research to say that's the fair number, or I wanted to buy a boat and therefore I needed that amount of money. Like, how did you get to your number that you wanted for the company?
Well, again, we paid very close attention to what was going on around us. So we knew some people were talking to us informally about, what they were selling their businesses for. So we knew that.
What were you hearing?
Just that the multiples were great, and yes, I had a number in mind, which was a factor of retiring some personal projects that I wanted to do, and so I came to the conclusion that best to just tell these guys that wanted to buy us, this is the number, and then one of them sort of shocked me by agreeing, but in the middle of all of that process, Martin, and again, this is why we talked about Martin and the partnership is, Martin has came through for me in very clutch periods. Martin suggested that we look at getting an M&A advisor, and I was probably on track to just trying to do it all myself since I'd done everything myself. But the more I thought about it, the more it started to make some sense. We didn't really shop it around much. We met with the people from Crosby's, David Fiddler, and the chemistry was good. They basically said, yes, we are going to take a piece of the transaction, but we'll sell the company for much more than you're going to sell it for. So what do you care? And their model
what did they
was,
think it could be worth? Did they give you any sense of what they thought it could be worth? And again, multiples of you. I don't think we've spoken what your EBITDA was. So, we can avoid talking about what your EBITDA was, but did they give you a sense of whether 6 times was fair? It sounds like you were hearing some sort of double-digit multiples of EBITDA. Well, scuttlebutt in the industry.
Again, John, I told them what I wanted. And I said, they were skeptical a bit to start, but I said, look, this is a hot space. Go make some phone calls. You decide if you want to be in. So
you told your M&A guys what you wanted,
and
said that's the number.
That's the number.
And yeah, and I'm not going to get you to tell me what multiple EBITDA that was.
No, you're not.
Would you tell me if it was more than would you tell me if it was double-digit multiple EBITDA?
No. I'm
okay. I'm going to assume it was, but that's just my assumption.
It's not allowed. But I what I will say is that Crosby did a great job of packaging up the business. Of course, it was accelerated by the fact that we had a great forecast, which they also thought was very critical. Plus all the Mars and everything else. They put a shiny package together. And they shamelessly went out and sold, put us on the block. And, they knew exactly how to do that. They elicited multiple bidders. And I can assure everybody that process for us was extremely successful. I have never had a regret, in dealing with them. And they've also been extremely helpful post-transaction because there are some quite critical things that need to happen in a post-transaction scenario as well.
Yeah, I want to get to those. So before I do though, just what was the most surprising thing they did in the packaging of your company? And I'm really emphasizing the word surprising. You're a sophisticated business person. You've been in this industry for a long time. Not much gets past you, I assume. And yet I'm assuming there were still things in the way they chose to take you to market or position your company that were like, I wonder why they're doing that.
Yeah. Well, so, the trick with this is to make sure that your EBITDA net EBITDA is as big as it possibly can be. And what these guys are good at doing is looking at your business and saying, well, okay, all that money that we're paying, these guys or isn't needed in the longer term. And so we can adjust that EBITDA to be a larger number. Every penny on that EBITDA is critical, right? And so I'd say that side of it is key. Walking you through the process. Nothing can prepare you psychologically for what you're about to experience. It's a really kind of critical thing to be able to sell your business and run your business at the same time. Making sure that the whole process stays on the rails as well.
Mm-hmm.
If
were you and Martin aligned on the value of the company?
Yeah.
Yes. Are you similar ages or?
No, he's 10 years younger than me.
Okay.
But
how did that play a role?
I don't think it really did. Martin strategically understood where we were at, that this was a platform play, that, we wanted to make sure that we all had a seat and the music stopped, and he was quite happy with that. I think now he's got to figure out what he wants to do. But, I don't think that was an issue.
Offline, we talked about a change of ownership clause. Can you walk me through how that impacted the transaction? Right.
So lessons I learned about this process, especially as a reseller, one of the key things to do is to make sure you're the guy who's officially the vendor of record in the company. And that can be all a big process all by itself, and is part of what a company is buying you for. So we would, variously, the sales guys would send me the reselling agreement or the vendor specific agreement, and we'd have to jump through hoops and everything else. And ultimately I would have to decide what are these people asking for? Is it doable? So for instance, sometimes they want a lot of insurance and this kind of thing. One of the things I didn't pay any attention to at all were clauses around change of ownership. So we had like 100 contracts that were all in our wiki. We were great documenters, but we weren't systematic enough in extracting from those documents, for instance, the things that really mattered, which was change of ownership provisions. And there are two types of provisions that you want to be watching for. One is just notification, which is okay, but you still got to do it. And then the second is actually getting permission from a customer to do change of ownership. And,
I'm so glad
in a couple of cases, I wish I had pushed back on that. And there's a few, you need to give, it's a catch-22 as well, because unless the deal takes place, you don't really want to tell your customer that you're looking for a change of ownership.
100%.
Sometimes these deals don't happen, they don't go through.
I'm so glad you raised this. So I want to summarize what I've heard and make sure my listeners hear this and sort of put an underline over this point. You have large clients, many banks and large integrated companies that have these SLAs or service level agreements, these contracts essentially that they put in place with vendors. And there's a bunch of boilerplate language in there. And one of the clauses in many of those giant corporations that they ask for as a kind of a blanket default position is a change of ownership clause coming in two flavors. One, you're obliged to notify, hey, we've changed, the ownership has changed. Two, that you have to seek their permission before a change of ownership would take place. Otherwise, the contract would be nullified effectively, as I understand it. What were the ramifications if you did not choose to tell them that they would effectively be able to walk away from the contract obligations?
Yes, potentially. I mean, as it happened, it's just a formality. I think again,
it's one of those things you can probably get. You probably get out of a contract if you're thinking that within 10 years, within 20 years, you're thinking of selling your company. You can start scrubbing those things out, changing it to notification as opposed to permission up front, so that 10 years down the road you won't live to regret it or have to do what you did, which it sounds like scramble at the last minute, going to all these old clients saying, "Hey, can you please waive this?"
Yeah. We didn't have too many problems on the change of notification. And I think again, one thing to be wary of is who are you and what is your relationship with the customer. So if you're a unique supplier to that customer, so you're not just a reseller like we were, because the customer could just pick somebody else to do the reselling and not a big deal. But if you're a unique provider to that customer with a unique product, I imagine the customer will have quite a few things to say about a change of ownership. So that's just how I would look at it. And the way that I would have gone about it is I would have said, okay, every time a contract comes in through the door, what are the 5 things or 6 things that we actually need to properly document here? Change of ownership, insurance, that kind of thing. And we would have had a big table and we'd be able to go, okay, we've got to tell these 20 people this one's a problem, or we would have tried to have changed some of those things, proactively.
Got it. So let's go back to the sales. So Crosby, you engage Crosby, they package it up, great book, sim, whatever. They're taking it to market. Do you tell your employees what if anything have you told your employees at this point?
Nothing. Nothing.
Are you worried that they're going to find out?
It's got to remain confidential, and it's got to remain confidential because first of all, the deal may not happen, in which case nothing's happened. So we did have some of the key staff who were part of the process of helping me sell the company were looked after, and and I do have some thoughts about kind of how we got the business going and some of those key staff and how they played a role in our success as well. So a small number of people were aware, and that's it.
Got it. How did that feel for you as the CEO to have this giant secret that you were kind of walking around with?
Yeah, it's not easy. I mean, it's even a case that you can't even really tell your friends. My wife was helpful in reminding me that this is just something that is not to be discussed. In terms of the staff, I was back and forth on this one. So I thought to myself, well, the hardest part about this is that we had built a great culture. In terms of building a culture, the culture does play a very significant role in the success of the business. And
it did for you?
For us, it did because of our high retention rate. Okay. If your retention rate is very high in our game, then it's you're not paying ridiculous amounts of money to headhunters to go fill holes in your professional ranks because people don't want to leave. They actually love the place. And
so you had this great culture, high retention.
Yeah, and we did that. We did that through all sorts of tricks and things. The moment it looked like the pandemic was on, I sent everybody home and said, you don't have to come to the office. Forget it. We were well ahead of the curve there. And it turned out to be one of the most inspired things because so many people actually didn't want to live in the center of Toronto, and they were able to go to, an hour north or 2 hours north, buy a much nicer house, have a much higher quality of life. In one quick decision, we were essentially giving the staff a much nicer lifestyle. And then we just shut the office altogether and said we'll forever be a virtual company. And again, I think that was very popular. We did monthly cocktail parties. That was it monthly? No, every 2 weeks we had a cocktail party. And then we started bringing in entertainers for those cocktail parties, kind of entertainment, comedians, all sorts of things like that. We started spending money on talent. We would still get together in person, but we put a lot of effort into the culture. And what that also meant was that anybody who didn't fit with our culture, we weeded them out very quickly.
How did you choose to eventually tell them that you'd sold the business to @𝙬𝙬𝙊𝙒?
We told them on a conference call, and they were upset a bit. But many of them are certified professionals. So Atlassian has a certification process. They get very, very well certified. They're able to go work for anybody they want to, and they're very high demand in our space. And that's part of the reason why the culture is key. We had a terrific project management office PMO leader. She really was kind of the mother hen of keeping it.
But I'd be curious though, how did you explain the rationale? Like, like what were the words that came out of? I've heard from a lot of founders, this is the hardest conversation that they've ever had in business.
It is
standing up in front of their clients, their customers. And
it is difficult. I don't know whether have you seen that baseball movie, the one about the team that was statistically, he hired a statistician, right?
Yeah. Moneyball. Yeah.
Moneyball,
Brad Pitt.
Okay. Do you remember when he was asked to let a player go in a trade?
Yeah.
And he said, how do I go about doing this? Like what is the methodology? And he says, don't muck about. Just sit them down, tell them this is what's happened, and things are going to be whatever they're going to be. Great. Right. And so, all our staff knew that there were acquisitions going on all over the place. They could see it. I mean, it was announced regularly. I'd say every 3 or 4 days there was another acquisition. And I got on a call with the company, and I simply told them. I said, Martin and I are exiting. I'm not a spring chicken anymore, and the opportunity has presented itself for us to exit the company. The acquirer has made I've actually selected this acquirer. Wasn't the best bid, but they committed to keeping 100% of the staff, and so that we felt that was the best option that was available. And
how many offers did you get on the company, like formal LOIs? 3. And what was the percentage difference between the 3? Can you share, like, plus or minus? It sounds like they would trade in relatively small range.
Yeah, it was close. Yeah.
And do you think that's because your M&A advisor, you'd been very clear up front, hey, this is the number I need. Did you get the sense that your M&A advisor had sort of tipped the market off to saying, like, you got to be in this kind of ballpark?
I suspect so. I suspect
it was. You don't know, but
I don't know. I don't know for sure. I suspect it was kind of like a Q&A. Am I wasting my time, David, if I offer this? David might have said yes. And so they might have gone back and forth, but that's the sort of thing that's great, because they, all that dirty work is done by the M&A guys. We can stay out of that kind of side of it.
And so you said you didn't accept the highest offer, although there was not a huge difference between the 3. One reason you chose the highest offer was they said they would retain 100% of the employees. What else attracted you by the offer that you accepted? What else was attractive?
In these sorts of deals, what you're going to see, what we saw, are different flavors of how things happen. So a part of the deal would be cash, cash up front. Another part of the deal might be a note where they pay you out over a period of time. Some of it's going to be holdbacks. There was actually a holdback on me to stay, but it transpired that the business, that the acquisition was so successful and things were going so well that they didn't need me to stay, and so that was fine.
So
the final part of that, it would be, say, equity in the new venture.
Got it. And so there was cash. There was a vendor take back, or effectively a portion that was financed over time.
Yeah.
There was a holdback, and then you were asked to roll some equity into the new entity.
Yeah. And so when you look at offers, you have to look at what suits you. So what suited me was more cash up front.
Yeah. Yeah.
If you've got a higher appetite for risk, for instance, or you're younger, you might want some different scenario.
Were you aligned with Martin on those items? Because he was 10 years younger. Was he in the same camp as in terms of the proportions he was comfortable with cash?
Well, I can't really go into any of the specifics here, but what I can say is that the deal, the 𝙤𝙤𝙇𝙇 guys were very sensitive and they were clever, and so they structured my deal slightly differently than Martin's, so that Martin got what he wanted and I got what I wanted. And as I understand it, that's a little bit unusual in the industry, in these deals. But all credit to 𝙤𝙤𝙇𝙇 and the various advisors who were able to do that.
Got it. Yeah, that makes good sense. And when I think of a holdback, it's not a term I've heard before per se. When I think of a holdback, it's usually like an amount in escrow to make sure that there were
that's right,
no problem. Yeah. When you say holdback, did you mean like an earnout where you had to stay and meet goals, or was it simply like tied to your tenure as an employee of the company?
No,
you were asked to stay on effectively.
Well, yeah, the whole. Sorry, when I say holdback, I just mean an amount of money that would be returned if everything is as advertised.
Got it. Yeah. Also, I've heard that referred to as escrow. Maybe it's similar. I'm not a lawyer, so maybe it's something similar. But I just wanted to distinguish between an earnout where you were kind of being asked to jump on the hamster wheel and try to hit a goal in 3 years. Yeah. Or that's not what this was.
One thing that I would say was a lesson learned. Mm-hmm. If I go back in time. And it may not be all that relevant to your US listeners, mm-hmm. except insofar as they do business in other countries. We were doing business in the US, and we had taken the stand that it was our customers' responsibility to collect the taxes. Mm-hmm. That's not necessarily how things are. And I would say if you're doing business in Canada, for instance, and you're just trying to offload that responsibility to your Canadian customers, you might have some problems there.
That's super good advice.
I would definitely have been, gone after our customers for taxes from the get-go, I think.
Yeah. Very, very good advice. And again, another reason that having an M&A focused, or at least an accountant who's done lots of corporate finance work, is really important, and that you've got an accountant with you and a set of advisors who. And I just want to really reemphasize the importance of having advisors who understand mergers and acquisitions. And that's maybe different. Oftentimes the lawyer who incorporated your company, who did that, employee agreement 10 years ago, is not the same lawyer you need to advise mm-hmm. you on M&A.
Well, I can tell you the story about the M&A.
Yeah, please do.
So we had terrific counsel, a terrific corporate counsel. I very much liked him, and Carl Belkamp. And I tried to see whether, I said, let's see if we can get you to do this deal. But David Fiddler and the guys from Crosby were like, you got to get a corporate M&A lawyer. You just have to. And I knew how much it was going to cost, and I kicking and screaming into this.
Hundreds of thousands.
Yeah, it's a lot. It's a lot. And I guess what I decided to do was go with it, but bring them in at the very last minute. So the trick with that, is that you get your own guy to do as much of this sort of legwork as you can. The corporate M&A guys, they're quick learners. They don't need a ton of runway, and they'll just bill you an awful lot. So you kind of want to sort of say, okay, there's a deal document, and there are a whole bunch of things that you have to testify to. I call it the confessional. And basically the
reps and warranties in the legal industry.
Yeah, reps and warranties, the confessional, And there's a sort of strategy for having to deal with it. Just you can represent that, some things, and you just can't represent other things, because the reps and warranties are endless. I mean, they literally want your children, your family, everything. And you just have to sort of know which ones you can say no to and which ones you're just going to say whatever. And, all of that process is something those M&A lawyers know very, very well. And we were being acquired by a company, that had multiple sets of lawyers. So, I just recommend you go down that road, line them up, and give them a start line as close to the finish line as you can, and time box the amount of money you spend on them.
Super helpful advice, Miles. When you come to reps and warranties, just maybe walk me through in your own, for you, your stage of life, your business, your industry, et cetera. What reps and warranties were you willing to sign off on and say, yes, I will represent that we paid our taxes, for example? Although that might be questionable, just given the state sales taxes we just referenced. What things were you not willing to sign up for?
It's been a while since I did it. I can remember a flavor of things that really I wasn't up for. Some of these clauses are just catch-alls. No member of your staff has ever done anything illegal on any level forever. And I'm like, I don't know. Right. I just, no, I'm not saying that,
yeah.
Could be, and you say, to my knowledge, I don't have anybody who's ever done anything bad on my team, but I can't tell you for sure, and so what you want to do is you just want to sort of look at it just through the lens of, as a business person, be practical.
Yeah.
Just say to yourself, is that something you really would commit to? And what would be the implications of you committing to that? What they're trying to do is essentially create a hermetically sealed arrangement where there's no risk to them about anything, and they can sue you for all sorts of things. And it's not the buyer who puts this forward. It's the M&A people, the lawyers. They say, this is the standard template contract. Sign your life away.
Yeah.
And then there are a fair number of things that are okay, Yeah.
Yeah, for sure. And again, another benefit of using an M&A lawyer is that they'll know what quote market is and what is reasonable to ask for and what is not reasonable. And so they will advise you, you're never going to get them to change this. And they'll also say, this is a total overreach. They're way out of bounds here.
That's right.
You can get them to move.
And there are some very critical stages in a deal. So for instance, at the point of transaction, there's going to be a net working capital calculation, which in and of itself is a form of holdback. You pretty well want to
explain that. Explain what a net working capital calculation is for folks and how that plays.
Yeah, I'm trying to remember exactly the technical definition of it. You probably know better how to describe it, John, than I do.
It's basically, I understand, it's a certain amount of money that needs to be in the bank account when you hand over the keys. You don't get to scrape out all the cash. Yeah. You've got AR, and you could make the case that you have that should be yours, and it's collectible. And there's retained earnings. This question of this rainy day fund that you've had for 3 years, this amount of could be a lot of money in some businesses' case. Who owns that?
Exactly.
It's the cash that basically.
And then they do a true up 90 days after, which then says, was that right or was that wrong? And so the net working capital calculation is usually very technical, and it's usually based on historic numbers. I try as I could to get into the detail with it. I never could quite understand it. But one thing I knew is that, the Crosby guys were on my team. And when these discussions took place with the buyer and the M&A people, and, it was quite clear, that whatever was the outcome was the right outcome for us. I felt safe with it. I think if I didn't have an advisor who really knew this space, I would feel quite nervous about this, So for me, that was one of the critical elements that you have to deal with.
Yeah, great points. This has just been amazing, full of wisdom and knowledge and so forth. Are you up for a quick lightning round before I let you go? Just a couple of questions that we can finish up with. What was the slimiest trick that an acquirer tried to play on you during the process of selling your company? You said you got 3 offers. You talked to lots of people. What was the slimiest sort of trick or scheme that you managed to avoid?
I don't know that I'd call it slimy, but I will say when in my experience that there's a set of stages in a deal. One is where there's a presumed value of the deal, which is in the letter. It says, this will offer you this much money, blah, 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 and all this sort of stuff.
Letter of intent.
Yeah, letter of intent. But what then happens is there's a stage where they confirm the value of your company. I think in our case, trying to get them to actually formally agree with the valuation took quite a long time. And it sort of dawned on me that actually it was never going to be in their interest to ever say what it was. Because once they've confirmed value, then we have to move quickly to the contract. So I think, taking my time again, I think we might have been a little harder lined. The other thing about confirmation of value is that it's tied typically to your exclusivity period, right? So it's usually 30 or 60 days after the letter of intent. It expires, which means you could then go to the market and find somebody else to buy your company. So, I think what looking back, you just need to be mindful of kind of holding everybody's feet to the fire around confirmation of value. It's not a slimy thing because it's just a negotiating tactic, right? And,
Yeah, that's actually not something I've heard of before. I have heard. I just want to dig in. So you're saying that in the letter of intent, that you signed that had no shop clause or an exclusivity period, they gave you what their offer, like it was a number, and that part of their due diligence was to confirm the value of the business in their eyes.
Yeah, and
okay.
All the buyers now are doing quite a large amount of due diligence. According to, the Crosby guys, it was more due diligence than they had seen in the past.
Yeah, the entrepreneur's proctology exam, I've heard it referred to as in a crude sort of way. What was the lowest emotional point that you reached during the process of selling your company?
Lowest emotional point. I think it was, the whole business of the start. Like it's as I mentioned to you, it is like having that conversation of trading a player, but psychologically and emotionally, leading up to that, I think it's very hard. That's probably, the hardest thing.
Highest emotional point?
Highest. Oh, I think probably there's a day, the last day of the deal, where everybody is on a conference call, could be 30 people, literally. And this call is basically, was headed up by our lawyer, Duncan Snyder at Gowlings, who is coordinating with their chief lawyer and basically they do around the table, like, okay, we're settled on this. Joe Bloggs, do you have any concerns? Is this a go? And you go right around everybody. And then they say, okay. And then suddenly all the money starts moving. That's kind of like crazy. That's a crazy kind of high point, of course, because of all the work that's gone into it. And you suddenly are relieved that this thing has actually happened.
What was it like with you and Martin at that period of time? And I mean, a lot, I'm sure you each brought something to the table, but I think it's fair to say you led much of the growth and you were a heavy piece of the success of the business. Did you ever sort of receive acknowledgement with Martin, or that, thanks that you showed up at that conference all those years ago? Was there any of that? Did that conversation ever happen?
Oh, yes. I mean, in a deal like this, one of the things that happens very early in the process is that there's an agreement as to who the designated person is for the transaction, just so there's no no misunderstandings. You know, I think it'd be fair to say that Martin had a great deal of trust in me and a lot of maturity to say, okay, Miles, I trust you to look after our best interests. I mean, after all, why would, if it's 50-50, why would I screw myself? So, you know, I think that's the case. He's always been very supportive of me, and it's one of the reasons why I was very happy with the arrangement. You know.
Got it. Yeah. As you prepared for the exit, it sounded like you definitely leaned heavily on your M&A professional, Crosby and Company. Were there any other resources that you turned to that you could switch our listeners on to that they might find helpful? A book, a TED Talk, a YouTube channel, like anything that you use to kind of educate yourself about M&A?
Yeah. I mean, I guess knowing what's going to happen in sequence is helpful. So, you know, make sure that, like, I kind of did know what was going to happen, but still the entirety of these events, you know, such as the networking capital and the deal day and the number of reps and warranties, still the entirety of these things kind of overwhelms you a little bit. Mm-hmm. You know, I did hire a very, very good CFO, and she was fantastic. And I would never have been able to get through it without her. So, you know, my general take on it is that, you know, the higher the quality forecast and planning and help around all of that, the better. I think what I would say about YouTube and the tools and everything else is that it's not always easy to know how legitimate the information is. You know, how you can end up getting too many pieces of advice and go sideways. You know, your advisor who's going to be successful, if you're successful, has done the deals many times. Just ask them questions. Just stay. David and I spoke to each other probably 6 times a day. You know, and sometimes he was awake at 2:00 in the morning, and I was awake at 2:00 in the morning, and we would talk about things. I mean, it's a very intense, very, very intense process.
What did you buy yourself to celebrate the win? Give me a trophy that you bought to commemorate.
Well, you know, I nearly bought a car. I nearly bought an expensive car.
What did you have your eyes on?
I'm not going to say. Expensive.
Oh, come on, Miles. It's all between friends. You can tell me.
Well, I looked at a Bentley.
Wow. You know, okay, that is a fancy car.
One of the things that I would say though is that look, I didn't in the end make the purchase, and I think probably there are a number of things that I nearly did, and I'm glad I didn't do them. I think sometimes you think you need to buy yourself a trophy because you deserve one, only to realize that that's kind of silly, and you're just doing it as a pride, you know, thing. It doesn't make any sense to do it. So, in the end, I ended up with a new set of golf clubs, and you know, we have some big housing projects, you know, that I want to do.
What kind of clubs did you buy?
Well, I spent the winter at Modern Golf, which is one of those golf simulator places. And they're very neutral about which clubs are best to use. And a fantastic data-driven assessment of your golf swing is just unbelievable. And they send you in a file of your performance. And so I tried everything. But compared to my T200s, the Mizunos were just hot metal, were just like incredible. Like I was getting 30 yards extra and more accurate. So it's a data-led sales process like Mars. And I loved it. And so, you know,
There
I'm
you
spending
go.
more time on the
So you're swinging Mizuno.
Yeah.
Mizuno.
And ping drivers.
All right. Ping drivers, Mizuno. What do they call them? I don't play
Hot
golf,
metal.
so I don't even know what metal. Thank you. Hot metal. There's a whole new language I got to learn if I'm going to get into golf at some point. Miles, I'm so grateful for you taking the time to share this story and some of the kind of inside baseball on the deal itself, which was super helpful, I think, for me and all of our listeners. Tell me what you're doing now and where people can reach you if they wanted to reach out and say hi on, I'm assuming LinkedIn is the best place, but I mean, you tell me where people can find you.
Yes, I'm on LinkedIn. And you can email me if you want at Miles, Miles, at faulknerconsulting.com. So that's Faulkner consulting, all one word.com. You know, I've taken it easy since the deal went down, but starting to, you know, bring my head up for air. And, you know, I look back at the process of building the company, which was a passion of mine. And all the experience that I've had, whether it's in HR, marketing, sales, how to be a reseller, and also then the sales process. I'm interested in helping other companies go through that successful journey, you know, either as a director or as an advisor. You know, I'm told that quite a lot of early stage companies do look for directors, but on a sort of almost a tiny bit of equity basis because cash is tight. I'm interested in those sorts of arrangements.
I appreciate you sharing that, Miles, and we'll put all of that, including your email address and contact information at builttosell.com. Miles, thanks for doing this.
All right. My pleasure. Thank you.